A mega day for AI and crypto, a kind of a meh day for everything else. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Romaine said it's been kind of a meh day. Yes, true. You look at the S&P 500, up marginally, up 0.2%. But after closing at a record high 15 times in 2024, the index is on its way to doing it yet again. Some big catalysts this week. You've got the big jobs report on Friday. You also have Jay Powell speaking before Congress starting on Wednesday. Treasuries are lower with the 10-year yield ticking up by 3 basis points as there's a lot of corporate bond issuance before Powell begins speaking. Dealers are expecting as much as $35 billion of supply this week and $130 billion of new issuance this month. And it's not just U.S. stocks that are setting record highs. The Nikkei 225 in Tokyo closing at a new record above 40,000 for the first time ever. And Bitcoin eyeing that $69,000 record high. Romaine, we're on watch for Bitcoin.
Yeah, on watch, of course, for that 70,000. But we go back to the U.S. equity market. It's kind of funny to be talking about stocks taking a breather at the same time. Hit a record high, but I guess that's how record highs goes. A lot of folks out there really assessing valuations right now, the shifting momentum, and of course that big batch of economic, corporate, and monetary policy reports that Scarlett said we're going to get this week. JP Morgan strategist led by Mislav Mateka telling clients, stay overweight growth versus value stocks. Cites an unhealthy, narrow leadership in this market. But David Kostin and his team over at Goldman, they say unlike the broad-based growth at any cost that we saw in 2021, investors are indeed paying high valuations, but mostly they're paying for the largest growth stocks out there. And that's going to be key here, because if you are out there searching for value, the big question really is, do you focus on those traditional elements of value or something maybe a little bit more modern? The question is more than academic. This was supposed to be the big moment for investors who were reeling from that 2022 bear market, who pushed more than $60 billion into ETFs, focusing on dividends in 2023. It's a traditional trade with a lot of promise, but so far, not much in terms of relative return. The SPDR S&P dividend ETF has a total return of less than 4% since the start of 2023. You compare that to 38% for the S&P and a 78% total return on the NASDAQ 100. The Schwab dividend ETF has only returned 8%, and Vanguard's high dividend yield ETF 11%. We're going to talk a lot about that later today with a legend in this space, Daniel Paris at Federated Hermes, who argues that U.S. financial markets are poised for a return to more traditional business-like relationships that should make dividend plays more popular for investors. In the meantime, though, let's go back to it. Where growth and growth wins out, with investors still enamored with the hopium of AI. Taiwan Semi today at its highest level ever. Nvidia overtaking Saudi Aramco in market value. Second-tier names like Supermicro taking its year-to-date gains, Scarlett, to more than 300%.
I love that term, hopium. It's a new technical term that really perfectly describes this market. And for all the bullishness apparent in U.S. stocks, we come back to the same old concerns. The S&P 500's gain are built on narrow leadership. This is the percent of index members that are outperforming the actual S&P 500 itself. Only 28%. So that means 72% of the S&P 500 members, including Apple and Tesla, are actually drags on the S&P 500's performance. Now, we have not seen this type of concentration in performance since going all the way back to 2000, the height of the dot-com bubble, which, of course, raises questions like, are we in a bubble right now?
All right, well, let's pose that question to our next guest as we kick you off to the close here at the start of the week. Jay Jacobs is joining us, U.S. head of thematics and active equity ETFs at BlackRock. And there really is no bigger theme over the last year or so than AI right now. And I think a lot of people thought that this trade would have run its course, but we're actually seeing that trade really start to broaden out.
Well, we've been waiting 75 years for AI to become a thing. No, really. I mean, you go back to the Turing test. That came out in 1950. So this was finally a major unlock in AI. What we are seeing is a broadening, though. This is not just about the Mag 7. We have started to see market participants realize that there are other parts of the AI tech stack that benefit from AI's adoption. It's more semiconductor companies. It's companies that process large amounts of data. It's the digital infrastructure that actually has to house all of this server power and semiconductors. And frankly, it's a lot of tech companies that now can leverage AI in their products and services that they offer to their customers.
I love the context about 75 years. We kind of forget that this sort of newfound technology isn't all that newfound, but it gets to this idea of how investors sort of capitalize on it. And we've talked so much about the Nvidias of the world. That was the play, Microsoft, if you will. When when we talk about how you value a company, particularly those companies that aren't named Nvidia or Microsoft, the ones that are maybe new to people's minds here, how do you do that in a way where you take into account the long-term promise of AI with maybe the short-term reality that the profits aren't necessarily going to be there just yet?
Yeah, so different parts of the AI tech stack are going to start to realize revenues and earnings at different periods. So right now, because we're so much focused on training these AI platforms, this is really compute intensive. That's why you're seeing semiconductors really win, because they are being rewarded with revenue. They basically can't sell these semiconductors fast enough to meet this demand for AI. But as AI starts to expand, that demand and that driver of power in the market is going to shift to other companies. So, like we just said, after training happens, it turns into inference, which is when you're running AI models very efficiently. That's when it's in products and services. That's when you look at software companies that maybe can make their products more appealing to customers through AI. Maybe they can reduce costs through AI. And so part of this is really projecting out the growth of the space, and another part of it is really understanding on a risk-adjusted basis how likely and how big is this theme likely to be in the next 5 to 10 years.
You talk about projecting out growth for the space. That also entails a lot of spending by these companies.
Yeah.
Have investors properly priced for that degree of spending?
I think they have, and this goes back to why the Mag 7 has done so well thus far, because the ingredients for AI is you want a lot of data, you want a lot of money to be able to buy semiconductors right now, and you want a lot of engineering prowess. And the Mag 7 has a lot of control over all three of those things. But again, as these platforms get more powerful, as they start to be commercialized, as people start to incorporate ChatGPT and Claude into their own products, then you start to see the benefits of that AI start to spread beyond the Mag 7 into what really could be a rising tide for the entire tech sector going forward.
And a rising tide for the overall market, as we've seen with the S&P 500 making 15 record highs in 2024. I mean, I want to take it to a broader conversation now, because some people say, have a Teflon market where no bad news sticks. Do you buy the idea that good news turning into bad news is what may ultimately pierce this Teflon?
I don't know. I think right now there's so much money on the sidelines. There's $6 trillion being held in money market and cash in the United States alone, that there's just a lot of dry powder that if you can continue to see moderate to good news, that will create really powerful tailwinds for the markets for a while to go. But even if there is negative news or things start to sour, there is a focus on new tools, new ETFs that can be more defensive as well. So, for example, we've brought out buffer ETFs, which protect against the downside in market movements, because a lot of people have been waiting on the sidelines. They've seen the markets rise, but they're still nervous about a pullback. So if you can be able to participate and protect against the downside, that can be very powerful for investors who are inching back into the markets.
Speaking of downside, even Nouriel Roubini sees solid U.S. economic growth ahead, but he says, of course, there's a flip side to that. Let's take a listen to what he said.
What if growth is well above potential because of technology or other factors, and then the Fed doesn't cut 3 times, only 2 or 1, maybe some people say 0. Last year, revisions of expectation about the Fed in August and September led to a 10% correction of equity. So I think that's potentially, paradoxically, that good news on growth may be bad news for the market.
What worries you the most when you think about the drawdown, when it comes, and how quickly it could unfold?
I don't know if it necessarily will come. We could see just a slowdown. We could see just kind of sideways markets for a while. I think what this means for investors is really being diversified across your bets. So, the U.S. has been a tremendous growth bet for the last decade. We do think this is time where investors can start looking at things like emerging markets again, where we're seeing huge economies growing at incredible paces. I mean, look at India growing, almost 6% a year. It's poised to become the 3rd largest economy by 2027. So really this shift to not just looking at a US-centric view for growth going forward, I think will help investors weather, more storms in the market.
Jay Jacobs, U.S. head of thematics and active equity ETFs over at BlackRock, helping us kick off to the close here on this Monday afternoon. Coming up, a deeper discussion here about what's going on with value and dividends. Are they poised for a comeback? Companies across sectors are beginning to increase those dividends this earnings season, but they're also increasing buybacks. It's an interesting dichotomy here. Daniel Paris, the author of the new book, The Ownership Dividend, joins us with his thoughts.
Plus, we're going to drill down into the airline sector as American Airlines signs a massive deal for new Boeing 737 MAX jets, and JetBlue abandons its $3.8 billion bid for Spirit.
Plus a focus on Lyft, a focus on DoorDash, and a focus on the possibility that, could they be combined? We're going to speak with someone over at RBC who thinks, at minimum, a partnership between the companies may be in the cards. All that and more coming up in just a bit, right here on Bloomberg.
It's a huge week in politics. Tomorrow, It's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
Busy news day in the airline sector. American Airlines agrees to buy 260 aircraft, including a huge deal for Boeing 737 MAX jets. And of course, this comes as JetBlue announces it is abandoning its $3.8 billion bid for Spirit Air. Bloomberg Intelligence senior analyst George Ferguson joins us now. George, is this an endorsement of Boeing or a reflection, really, that there's a reality that airlines don't have that many choices when it comes to their wanting to buy new aircraft?
Well, I mean, I think it is the reality that there are only two choices right now. It reminds me a lot about there was an American order many, many years ago where they did a lot of negotiating over the A320neo when it was first coming out and the Boeing MAX. And when they got done with the negotiations, they thought they had such a great deal from both manufacturers that they took both. And so, and again, it seems like they're sort of, they're going down the middle here. They're going to buy, some of the 321s out of Airbus. They're going to buy 737 MAX 10s out of Boeing. These are very similar type aircraft, very similar sizes. I really think of them as sort of the primary competition in the large narrow body. So it's interesting to see American divide the buy on it. But maybe they are concerned about what the timing might be on a MAX 10, and they want the 321 sooner.
Good news for Boeing, George. Another big story out there in the airline space involves JetBlue formally walking away from that merger, if you will, with Spirit Airlines. And we should point out that was going to be an acquisition that seemed to be largely driven by their need to get their hands on planes sooner than expected.
Yeah, look, I think when that acquisition was announced, I think there was a lot of thought that you ought to have a pretty good order book because you needed airplanes as we came out of the pandemic. Honestly, I think that's probably starting to change that thought, right? Because right now, when we look at domestic fares, they're falling, and so airline profits, they aren't what they were last decade. So the airlines are profitable, but they're not hugely profitable. And I think JetBlue, they'd really rather shore up their balance sheet here than buy a lot of airplanes. And we kind of expected, right, to wrap it up, we expected that this transaction was going to get unwound, that there was no way they were going to be able to get an appeal through the Justice Department in time. Yeah,
well, even as they shore up their balance sheet, they're going to be out something like $500 million because they've already paid Spirit $425 million. They have to hand over another $69 million tomorrow. So there's a lot of cash changing hands. Carl Icahn, George, has a 10% stake in JetBlue. Is this good news for the stock and the company? How does this unfold?
So, we saw Carl Icahn invest previously in airlines like TWA, which ultimately went bankrupt. I'm not sure that I'd call Carl Icahn being on the board as good news. I feel like it's probably a disruptor for the new CEO as she's trying to take JetBlue down a new path or down a path other than the acquisition. So I think it's probably, again, more of a disruptor right now.
All right, George Ferguson of Bloomberg Intelligence. A couple of big stories in the airline space, including Boeing gaining new orders for that 737 MAX, and JetBlue now finally walking away from that deal with Spirit Airlines, walking away kind of against its will to a certain extent.
Yeah, and of course they have a new CEO who has to kind of fix everything now that that Spirit deal has fallen apart. My question here is what happens to Spirit Airlines? Does Frontier come back and make a bid? Does it just kind of operate on its own?
It'll be interesting to see what happens. I mean, their whole base case for why they thought this merger would be good was the idea that Spirit's days might be numbered if they didn't have a white knight there. So it'll be interesting to see whether there couldn't be a combination that is going to satisfy regulators. But again, you're still talking about a company sitting on, a couple hundred orders that I think a lot of airlines would like to get their hands on.
Well said.
All right, coming up here on the big program, a closer look at some of the big movers of the day, including Lyft and DoorDash, a 5-star rating by the analyst over at RBC Capital, who actually says that a partnership between the two companies shouldn't be as unthinkable as some may have thought. That's coming up next, right here on The Close on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Supermicro. Goldman Sachs starting coverage of the small cap turned big cap maker of servers with a neutral rating and a 941 price target. That's below where the stock trades today, as you can see. The analyst calling Supermicro an AI winner, but still views the stock as fairly valued following an almost 1,000% move since the beginning of 2023. He also warns of a potential slowdown in growth starting in 2025. Investors, they're happy with what they see so far, up 25% here on the day. Next up, G3 Apparel, owner of brands like DKNY and Bass Outdoor. A downgrade today to underweight. This over at Barclays with the analysts there projecting a 2% hit to revenue in the next 3 years. This is G3's largest customer, Macy's, announced that it would close 150 namesake stores. The analyst also cites pressure from G3's licensing agreements with Calvin Klein and Tommy Hilfiger, noting that without them, its portfolio is pretty basic. Those shares down about 11% on the day. And finally, let's take a look at Lyft. An interesting call here over at RBC Capital, lifting its rating to outperform. Analyst Brad Erickson conjuring up a partnership between Lyft and the food delivery company DoorDash that could rival Uber. He upgrades DoorDash as well, telling investors while the company likely won't buy Lyft, a partnership between the two would add significant value. Bloomberg did reach out to both companies, didn't quite get a comment on that yet, but the shares rallying here, about 5% here on Lyft, 4% on DoorDash on the day, and those are some of our top calls. And we do want to stick with that particular call there involving DoorDash and Lyft because the man behind that call joins the big program right now. Brad Erickson is senior analyst at RBC Capital Markets. That upgrade today on both of those names catching a lot of attention, Brad, not because of the separate upgrades, but the idea here that maybe they have a future together. What's behind that?
Yeah, I think kind of two things that have stuck out to us lately is that we do an analysis, a proprietary analysis, where we evaluate Lyft's competitive position versus Uber. And what we noticed last August was that analysis turned relatively more positive for Lyft for the first time in the 2 prior years. And so it got more positive again in January, and then we ran it again today as a part of the upgrade notes. And once again, it shows that, to us, it indicates that Lyft is competing on equal ground with Uber. Mm-hmm. If that's right, and that's the way forward, Lyft becomes a much more viable partner for DoorDash. So that's part of it. And then the other piece of it is that DoorDash is getting into all these new competitive markets, right? Grocery, retail, convenience, all this other stuff. Uber is proving out that a cross-platform loyalty approach works, and we think that at some point that becomes a really attractive option for both DoorDash and Lyft to partner in.
Well, that's what I'm curious about, because, I mean, this idea has been floated out there several times, and Lyft has made clear in the past that it actually saw value in basically remaining kind of just about transportation, not necessarily taking the same path in Uber. Is there any sense here that management is maybe willing to sort of consider this option?
Yeah, I think on the Lyft front, what I would say is, they have an established partnership with Grubhub, which is kind of the number 3 player in the food delivery space. The problem there is that Grubhub's market share has gone from, 25% about 5 years ago to about 5% today. And outside of New York and Chicago, they're not very relevant. So that's where we say Lyft could re-up with a much bigger partner, DoorDash, which has over half the market. So we do think there is an appetite from that perspective. DoorDash, we're not so sure. They have a lot of opportunities in front of them already under the existing opportunity set. But again, back to our point earlier, if Lyft is increasingly more viewed as a viable partner for them, we do think it's a possibility in the future. But clearly nothing imminent in terms of announcements.
Well, as you and Romain have been saying, the strategy makes sense. There's a precedent for it with Uber and Uber Eats. In terms of execution, what are some of the pitfalls that an Uber-DoorDash partnership would need to look at from the Uber Eats example that they could maybe, be mindful of?
Yeah, I think, as I'm talking with institutional investors through the day today, I think the one key question is Lyft doesn't have very many loyalty members today. We think probably under 2 million of its 24 million user base, whereas DoorDash, we think, has almost half it, call it a little over 15 million of not quite 30 million total users. So I think for Lyft to be able to tap into those DoorDash users, that's a very big opportunity, could drive a lot of rides. I think there's more questions around what DoorDash would be getting out of it. And so then you get into how much of the economics would they want? Does that become viable for Lyft? It's complicated, and obviously we did our best to sort of flesh out the note, but that would be kind of the biggest hurdle, I think, to get over.
What's the likelihood of Uber perhaps, front-running this and coming up with a partnership with DoorDash itself?
Oh, they have their existing Uber Eats business, sure. Plenty of runway there. They've obviously got it all in-house. I don't think there would be any reason to do that.
This gets us to a broader question here, Brad, about the long-term economics of this, let's just call it delivery, transportation, whatever the mashup is here. And the idea that Uber seems to have found its way to profitability. Lyft, for that matter, has flirted with profitability in a few quarters here or there. Do you see a future where we do end up with this duopoly in this sort of transportation delivery space, and that is going to be viable for both companies? Or is this a type of industry where you only really need one, at least one that could really dominate and be profitable?
Yep, totally. Yeah, this isn't like search, from like Google search, for example, which turned into a monopoly.
Yeah.
I do think it can be a stable duopoly. I think what effectively is going on is, remember, this is a city by city battle. This isn't like national market share battles necessarily. The market is underpenetrated. It's a secular growth opportunity. We think both Uber and Lyft know that if they play their cards right, they act rational, they will continue to grow nicely and reward shareholders for it, meaning both can work. If one of them steps out of line and, let's say, starts pricing irrationally, that's not a good thing. That's scorched earth for the entire space. Both stocks go down in that type of event. So we do think there's a huge sort of mutual incentive for these guys to play ball, play nice, play rational. And that's what we think we're seeing here with our analysis.
Yeah, avoiding mutually assured destruction then. Brad Erickson, really appreciate your joining us. Brad Erickson over at RBC Capital Markets with an intriguing note on a DoorDash-Lyft partnership. Coming up on The Close, a conversation on dividends and buybacks with Daniel Paris. He is author of The Ownership Dividend. A lot to discuss here, as certainly companies are stressing their free cash flow and some of the cash that they're returning to shareholders during this last earnings season. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romain Bostick.
And I'm Scarlett Fu, and it's another week in which most of the news flow, the headlines are coming in at the second half of the week, right?
Yeah, and it's going to be a big week. I mean, we get some big economic data at the end of the week. We are going to get some big earnings at the start of the week. And then in between that, we got Jay Powell on Capitol Hill, who, I don't know, is he going to say anything?
Well, I mean, he's going to be asked a lot of questions, and I'm sure he's going to dance around things. I mean, who's he talking to? Congress? So it depends on your view of Washington, doesn't it?
So no. Anyway, we may glean a little bit something here about the path of monetary policy as we move into, I guess, what a lot of people think is going to be a new era when it comes to rates, and maybe potentially a new era when it comes to the financial markets. Dividends, once an integral part of the investment process, have receded in popularity, at least here in the U.S. On the tech-heavy NASDAQ, less than half the companies listed paid a dividend by the end of 2022, leaving the median yield at zero. In his latest book, The Ownership Dividend, portfolio manager Daniel Paris argues for the return of the dividend for successful publicly traded companies as a means for more stable and secure investment returns. Pleased to say that Daniel joins us right now here in studio. He is the head of strategic value dividend group at Federated. Hermes. Great to have you here, Daniel. This is a book that kind of speaks to me because I kind of came of age in an era where dividends were where it was at. You know, when I was learning how to pick stocks and invest, it was all about look for the companies that were paying a dividend. That almost seems archaic these days. What happened? How did we get here?
Yeah, it's amazing that a strategy which is kind of core to Finance 101 has receded to boutique level over the last couple decades. And the book narrates how that really happened. The theme that runs through it is what happens when interest rates go down for 40 straight years. And then the book tries to answer what happens when interest rates stop going down. So we had interest rates declining for decades. Everyone got used to a lower and lower cash threshold. At the same time, buybacks emerged. They became more feasible after 1982. You did have the genuine innovation and world-changing nature of NASDAQ and Silicon Valley, and you had a very, very benign geopolitical context, the march of global neoliberalism. All that has come to a kind of a crashing end the last few years, and that's why I expect to see the return of the cash nexus.
Well, what sort of gets us there? Because I agree with you. We've sort of reached this sort of precipice, if you will. But are we going to go back? I remember hearing Warren Buffett a couple of years ago at one of his meetings was talking about how he felt dividends were a much more honest return of cash to shareholders relative to buybacks. But we know from an accounting perspective, buybacks tend to help the company a little bit more on their balance sheet than dividend. Okay, optically.
They certainly help Wall Street more. It's not clear that they help shareholders. They certainly do help share sellers. One of the key differences between a buyback and a dividend is that for a investor to benefit from a share buyback, they literally have to sell their assets. A funny way of benefiting from the ownership of a successful asset. A dividend's a much more natural way to benefit from it. I think it's more not return to some golden period in the past. It's just mean reversion. The last couple decades have been very anomalous. This cashless period of business ownership came into being, made a lot of people very wealthy. It's not illegal, immoral, unethical, but I think it is going to be shown as anomalous. You're going to see more of a return, a demand, now that interest rates are not zero and not going down. You're going to see equities have to compete for investors much the same way other asset classes have. And the growth canard won't matter anymore because, as you pointed out, most of the companies that are where there might be an issue of paying a dividend, tech companies already buy back their shares. They're not investing the money. They're buying back their shares.
Some are starting to pay a dividend, but we'll get to that in a moment. I'm struck that this past earnings season, the theme has really been free cash flow, right? The measurement of how much cash a company has left over after paying its operating expenses and maintaining its capex. How do you think about free cash flow, and at what point a company should use some of its excess cash to pay a dividend? Is there a certain threshold, a benchmark?
Yeah, the numbers now are all, and have been for the last decade or two, very, very low. That is, free cash flow payouts, particularly dividend payout ratios, have been in the 30-40% range. Companies are not necessarily investing that money. That a lot of it's going into buybacks. The dividend investor in this environment, by many, we'll call it corporate executives or Wall Street executives, are charged with depriving companies of capital of growth. That could not be more from the truth. If you're interested in a sustainable dividend, you want the company to invest what is appropriate, not only in operating expenses, but also capital expenditure. But anything that's left over, you as a business owner, a minority business owner, meaning not a majority controller, would expect that cash payment. So yes to growth, not necessarily yes to spend on anything that you want in wild abandon, but certainly yes to growth. And that will vary by industry and company as to what the right level of payout should be.
Okay, so let's talk about tech, because you mentioned it. 4 of the 7 Mag 7 names now pay a dividend. The exception are Amazon, Alphabet, and Tesla. And granted, these are pretty minuscule dividends, like 0.4% dividend yield. Is this going to be the new norm for tech companies, or is this something that only the biggest of the big tech companies can afford to do?
Well, it really depends on the profitability. In the book, I look at call it NASDAQ 100, top 100 companies, and there's plenty of cash flow for them to pay dividends. It's a matter of coming around to that. The book was published on January 31st. On February 1st, Mark Zuckerberg came out with the dividend. Obviously got a copy, read it very quickly, was persuaded. But I think you're going to see more large tech companies. They do have the cash. There's nothing wrong from a Wall Street perspective. There's a great deal wrong from my perspective with buybacks. But from a Wall Street perspective, there's nothing wrong with buybacks. I'll just simply say the bloom is off the buyback rose. And I think companies like Meta and the other tech companies, some of it, in those very large successful ones, will be moving towards what I refer to as the return of the cash nexus, a cash payment to company owners, not share sellers.
Well, so we get to this idea, though, too, when we start to talk about what sort of moves us towards that paradigm, right? Is it going to be coming from the companies, or is it going to be the demand by investors? When I was looking at the performance of a lot of the dividend only sort of ETFs and mutual funds here, there was a remarkable underperformance, at least over the last year or so, versus the broader market here. So there are a lot of people, they look at those returns.
Yep.
They look at the returns that you can get just doing the broader market or something else, and it's kind of no contest. So how do you get to that balance?
Yeah, not the last year or two, the last 15 years.
Yeah.
There's no comparison.
Yeah.
So non-dividend or de minimis paying dividend stocks have just gone up stratospherically for years, really.
Yeah.
It's really more the ownership concept that at least I, as a dividend investor in a stock market, for me, it's a matter of philosophy. That is, if I am a minority owner of a business, I would like a tangible connection with that. The fact that a stock might go up a great deal is going to appeal to stock investors, and there's nothing wrong with that. Buy low, sell high, repeat frequently. But as a kind of conservative business owner, I'm interested in that cash stake, and I think more and more people will be now that interest rates have stopped going down, the theme of the book.
So, Daniel, your book's name is The Ownership Dividend. And one thing a dividend does do, as you were telling us earlier, is it opens the door to employees getting paid dividends and being able to partake in the good fortunes of the company as well. Explain what you mean by that.
Yeah, companies that reward their employees with shares that don't pay dividends are really incentivizing them to sell, not buy, because they don't receive an income stream from that stake in the company. Whereas companies that have dividends and reward their employees with shares, that dividend is an incentive to keep the shares because you're seeing something tangible coming from it. Off screen, we were talking about employee ownership plans, the original ESOPs. They were funded when they were created back in the 1950s with the dividend from the shares. If you don't have a dividend, that original type of ESOP doesn't work. It doesn't mean ESOPs haven't evolved in recent decades in other directions, but the basic concept that an income stream can be used to purchase something going forward, I think is still useful for employee ownership plans going forward.
But you know that many companies don't want to get locked into that as well.
Yeah, and I'm not trying to lock companies into overpaying dividends.
Yeah.
Frankly, there are a number of companies, S&P 500 companies, that probably pay too much. The U.S. structure of dividends is somewhat inflexible. There are other patterns of dividend payment, a low regular payment or lower regular payment, and then flexible dividends or special dividends. You see them in other parts of the globe. As much as I enjoy and comfortable being a dividend investor in a stock market, I do acknowledge that the pattern of payment in the U.S. Can be constricting at times.
All right, Dan, this is really fascinating stuff and a great new book out by Daniel Paris, head of strategic value dividend group over at Federated Hermes. Of course, that book is available now wherever you get your
reading material. Ebook, physical book, all of that.
Coming up here, a closer look at some of the big movers on the day, including a resumption of that sell-off in New York Community Bank this after Moody's and Fitch downgrading the regional lender. It's our stock of the hour, and it's up next right here on The Close on Bloomberg. All right, New York Community Bank Corp plunged 26% on Friday, and if you didn't think it could get any worse, think again. The share is down more than 20% today. Not only are we approaching the one-year anniversary of the Silicon Valley Bank blowup, but the stock now down double digits again on more bad news for the regional lender. Abigail Doolittle joining us right now for our stock of the hour, and I kind of thought that this sell-off might actually be arrested in some way, but it's continuing apace. What changed?
It is. I thought the same thing last week, that maybe that was a kitchen sink moment, that they weren't going to have to do anything else, but here we have the stock down again. And so we have two downgrades, one of them Fitch to junk. Moody's had cut it to junk back in February, but now they've also downgraded the long-term deposit rating to junk, and that's worrisome. It could create deposit volatility, especially around their mortgage escrow business. Back in February on a call, they said, and I don't know why they would highlight this, I guess it's something that banks do, but they said that if this particular rating were cut, that it could mean that they could see some outflows. Now, relative to what that could be, the mortgage escrow represents it's about $6 to $8 billion in deposits, or about 8% of the deposit base. Last week, when we were talking about it, of course, with the material weakness around loans, so the idea that maybe what they have is worth less. But now this is the idea, similar to what happened to Silicon Valley Bank. People got nervous, and so then they went to withdraw money. Could that happen here? We don't know. But they also haven't updated their deposits since February.
Well, that's what I'm curious about. We haven't seen that data yet, and it does kind of have a reminiscence of what we saw last year, where there was there was a lack of transparency, and then when it did come, everybody rushed to the door.
Yeah, that's a really good point. I just wonder if there's another First Republic lurking in there that we need to be mindful of. How are the other regional lenders performing?
Well, it's interesting because the other ones are really pretty good, and especially if you look at from the Silicon Valley Bank blow-up date of last year, not surprisingly, it is this bank, NYCB, that's underperforming in a big way. I think it's down more than 50%. Well, it has to be down more than 50%. It's now down 75% over the last few days. But the rest of the banks are down modestly, somewhere between 6 to, let's call it 20%. We do have Western Alliance actually up 13%. What's interesting, New York Community Bancorp, ahead of their disastrous quarter back in January, it too had been higher. This was one of the banks that was actually outperforming, maybe because of Signature Bank. But, on the deposit, what you're talking about, are they waiting to pull out a rabbit out of the hat and impress everybody so they can rescue the stock, or is it a bad number? We really don't know, but it's that uncertainty that's creating some pressure.
That would be a big gamble if they're waiting to come out and
you would think that they would
hat.
come out and reassure investors at this point.
You think regulators will come out and do that as well, unless maybe they're
they
okay
have a lot of
twist.
They have enough liquidity to cover the non-FDIC insured, uninsured right now.
So that's all.
Yeah, that's saving them right now. Yeah.
All right, Abigail, thank you so much. Stock of the hour, NYCB, extending its losses. Now, coming up on the close, we continue to count you down to the closing bells. Amanda Agati, Chief Investment Officer at PNC Asset Management Group, will be joining us next. A lot to discuss here as we have a big week with the jobs report and Jay Powell testifying before Congress on Wednesday and Thursday. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostic alongside Scarlett Fu. Just about 10 minutes until we get to these closing bells here. The market in a little bit of a holding pattern, but I think it's interesting. You're seeing still chip stocks get a bid. You're still seeing AI stocks get a bid. You're still seeing crypto stocks get a bid. It's just really kind of those bigger names that had driven the market last year that aren't.
Yeah, some familiar themes playing out once again, and the S&P 500 has now ticked into the red here, even as equity strategists raise their S&P 500 year-end targets. Savita Subramaniam over at B of A now sees 5,400, which is up 5% from last week's close, as her new year-end target. What's interesting, of course, is as you talk about the same stocks leading the market, Apple and Tesla, of course, have been laggards among the Magnificent Seven, and Apple getting another hit after it was dropped by Evercore and ISI from their bullish lists.
Well, at least for right now, folks can, I guess, count on the AI trade. How long that goes, who knows? Just today, Nvidia shares did jump to overtake Saudi Aramco. That company now the world's third most valuable public company. We had a chance to catch up with BlackRock's Jay Jacobs about continued optimism in this space.
What we are seeing is a broadening, though. This is not just about the Mag 7. We have started to see market participants realize that there are other parts of the AI tech stack that benefit from AI's adoption. It's more semiconductor companies. It's companies that process large amounts of data. It's the digital infrastructure that actually has to house all of this server power and semiconductors. And frankly, it's a lot of tech companies that now can leverage AI in their products and services that they offer to their customers.
Jay Jacobs helped us kick off to the close here on the big program. Here to take us to the closing bells is Amanda Agati, Chief Investment Officer at PNC Asset Management Group. And Amanda, AI has been the big theme now for more than a year, and I think a lot of people think that could continue to power this market going forward. I guess my question is twofold. A, do you believe that? And if so, is it going to be a bit more of a broad-based advance?
Well, thank you so much for having me. It's always nice to be with you. I would love to simply say, sure, it's the thing that's going to continue to power this market rally. But I just remain a bit unconvinced that at, basically price for perfection valuation levels, particularly for the S&P 500, that there is a lot of headroom to continue this market rally. And I think you've started to see it stall out a little bit here more recently. We really do need to see broader-based earnings reacceleration and participation from the bottom 493 stocks to keep this rally going.
We certainly didn't get that necessarily out of the most recent earnings season. There are a lot of people that think we might see that later this year. Are the economic fundamentals going to be supportive of that, Amanda?
Well, I think the key is that economic data has been coming in stronger than expected. And so to the extent that that continues, we should, with a lagged effect, start to see a broadening in earnings growth participation.
Okay, we're having a little bit of technical difficulty here, but Romain, your point is a good one, which is if we continue to see data come in better than expected, at some point that's going to have a negative repercussion, especially in market sentiment, which is building in all these rate cuts.
It's that weird balance, right? Of, we always talk about bad news being good news and vice versa, and how the Fed fits into all that. But I feel like we're in this kind of weird middle space right now where no one quite knows whether good news is good news or it's bad news. I don't know if that changes this week. I don't think it is, because I don't think Jay Powell is going to tell us anything on when he goes up to Capitol Hill. And that jobs report, I mean, unless it's a huge blowout either to the upside or the downside, is that really going to change the narrative?
And all the high-frequency data that's been coming out suggests that it won't be a big shift from what we've already seen, right? Everything's kind of copacetic. Things will continue to go on as they've been going on. So it's a big question mark about waiting for a catalyst and whether we're going to get one. Amanda, given that we're in a wait-and-see mode, what I find interesting here is that the volume in the Dow, the S&P, and NASDAQ is quite heavy. It's double-digit percentages up from the 5-day average, which, granted, over the past 5 days may not be that significant. But I'm wondering what it is about positioning that investors want to be setting themselves up for, whether it is later this month or later this year.
Well, I think it's really something I wanted to go back to, in that the economic data continues to be coming in stronger than expected. And so the Fed may have effectively engineered this soft landing scenario, which should lead to a broadening in earnings growth and an earnings real acceleration. And so those names that haven't really participated to the same degree that the top 7 have really have a shot at it. And so I think from a positioning perspective, investors want to make sure that they are exposed to those names, picking up some attractive relative valuations.
Yeah, there's also some positioning in the Treasury market as well, because there's a lot of bond issuance from companies coming out this week, as much as $35 billion in supply. We know spreads are tight, and certainly companies do want to raise money while rates are coming in. What are you seeing in terms of demand for that paper?
We're seeing a ton of demand. I mean, just the demographics in this country alone suggest that we should be seeing a lot more and persistent flows into fixed income markets. We have been seeing it. It continues here. And if the Fed is ultimately on the eve of a pivot and starting to think about lowering rates, there's certainly this need on the part of investors to lock it in. So we think demand is going to continue to be strong from a positioning and flows perspective, without a doubt.
So that gets us to the broader question. When we talk about market positioning and the idea that a lot of folks came into this year with the expectation that there needed to be a rotation of some kind, at least to a certain extent here, do you find that rotation or the need for that rotation to be material, or is it just kind of, I guess, nibbling around the edges, if you will?
We don't think that there's a material rotation that needs to happen at all. We've been running a somewhat defensive playbook for the last 12 plus months, but defense to us doesn't mean raise a ton of cash and move to the sidelines. It really just means stay very well diversified, don't make big bets on either end of the style spectrum, and really be focused on valuation and relative valuation in particular. And so it's definitely at the margin. There was time for a lot of material change that was coming into 2023, but it's sort of the same playbook for 2024 here.
We only have about a minute left, but I am curious about some of those big roadblocks, some of those big time bombs everyone was worried about, whether it was a regional banking crisis, the commercial real estate issues, or really just the overall idea here that there are still a lot of unresolved issues in the credit space here. Does that give you worry?
It does give me a little bit of worry. I think the two things that probably keep me up at night as it relates to the market is, will the fundamentals, will the use cases and business models of AI show up as fast as valuations have moved to incorporate that? So does that at some point disappoint the market? It's been such a driver. I think it could create a misstep. But the other one is certainly all over the headlines, what's going on with commercial real estate. We don't know what we don't know there. And there are a lot of underlying exposures that, have made bets that have clearly gone away from them. And just because the Fed may pivot and cut rates doesn't mean it bails out commercial real estate. So those are the two things that are definitely top of mind as it relates to this market's path forward.
All right, Amanda, always a great conversation. Amanda Agati, Chief Investment Officer at PNC Asset Management, helping us count down to these closing bells. Those bells just a little more than 2 minutes away here, with most of the major indices right now in the red, 0.2% right now on the Dow, about 0.1% on the S&P. Stick with us. A full breakdown of all of today's market action as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with Tim Stenovic, Sonali Basak in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms here on this Monday afternoon, Tim, where we see a market really trying to digest those record highs from last week and looking ahead to a big week of catalysts.
Yeah, still a couple minutes left, but who knows if we're going to hit a 16th record high this year in the S&P 500. Looking like it's going to close in the green. I do want to talk about something we just chatted about on radio, guys. The era of the meme coin is back. Can you believe that?
No, I don't.
Tell
me more, Tim.
Okay, there's Pepe the dog, Pepe the frog-themed coin, and dog with hat. This is new to me. I'm just learning this from Among the Most Read, Mu Yao Shen.
I think this is all just
the
to
Pepe
say
coin
it is certainly back.
Okay. Is that where we're at? Is this like the contrarian sell signal now?
That's what I'm thinking. This is like there's a sentiment indicator here, right?
So as soon as Bitcoin hits 69,000, what happens to all these other meme coins? That's the big question, right?
Can't believe it.
Well, not really, right? Because now you're waiting for that Ethereum ETF. And so if you think about it, perhaps exuberance can keep going because, even if interest rates stay higher, it has not popped the bubble of money going into these types of investments.
Yeah, it should be pointed out that on this day, you talk about the biggest movers. You got a lot of crypto stocks moving higher on the day. Coinbase up more than 10%. And of course, MicroStrategy, which does what MicroStrategy does, 23% here on the day. Happy Pepe coin day or whatever, Tim, that was talking about there.
I just look at this and shake my head. Every single day it continues rising. And these proxies, beyond the fundamentals, what are the fundamentals of companies like that, right?
More the majority of the stocks right now in the S&P 500 are higher on the day, but that's not going to be good enough to push this index into the green here, particularly with the big name like Tesla dragging everything down. The S&P 500 going to finish the day down only by 6 points or about 0.1% here. So just a little bit of a pullback off the record highs from last week. The Dow Jones Industrial Average lower by 100 points or 0.2%. The NASDAQ Composite lower by 67 points or 0.4%. And the Russell 2000 also lower here on the day, just 2 points or about 0.1% on the day, guys.
Yeah, looking at the S&P 500, Romaine, to your point, 299 stocks moving higher, 202 moving lower. Different story in the NASDAQ 100. 59 stocks down in the NASDAQ 100, 42 stocks higher on the day.
We were just talking with Amanda Gotti of PNC and talking about the broadening of the market moves. And if you look at the performers that are doing well among the 11 sectors in the S&P 500, utilities, materials, and real estate investment trusts. Utilities up 1.6% with 28 out of 30 names in the green. Materials up by 2/3%. The weak links here in the market today: communications services, consumer discretionary, and energy, each down at least 1%.
Hey, let's get to some of the gainers on the day today. When Carol's out, that means I get to do the stocks that are in the green. I do want to start with Nvidia. It did hit another intraday high on the day today, finishing higher by 3.6%. It actually claimed another milestone when we're thinking about superlatives. It overtook Saudi Aramco in market value, making the chipmaker the world's third most valuable public company, this after Apple and Microsoft. Shares of Nvidia up more than 70% just this year. That's after last year's 240% increase. We also did see President Capital Management initiating coverage with a recommendation of buy, setting a price target to $970 a share, so significantly higher than the $852 where it closed today. Also, let's talk about Supermicro Computer. Shares surging this after it was added to the S&P 500 in the latest quarterly weighting change. Shares finishing higher on the day by more than 18%. Deckers Outdoor is also going to be added to the S&P 500. This will happen prior to trading on March 18th. So a couple weeks away, but they're replacing Whirlpool and Zions Bancorp. And then here's one that I actually had not been on my radar. It's a company called Funware. It's a software firm, and it's Funware with a PHUN. It rallied 81% today. It's a software firm that worked on former President Trump's 2020 election campaign. And you saw stocks that are tied to the former president rally today. Digital World Acquisition Corp, Rumble. This is ahead of Super Tuesday. The U.S. Supreme Court also saying that Donald Trump can appear on presidential ballots this year. We got that ruling a little earlier. So investors sending shares of those Trump-linked companies higher on the day.
Just before we go to the decliners, I just want to point out MicroStrategy, which of course closed at that record high, up 20%, and right on cue here, announcing a convertible bond offering, $600 million worth of convertible bonds here. So shares down in after-hours trading just by a smidge.
So do you buy that in Bitcoin then?
I was thinking.
Well, they're saying they're going to use the proceeds to buy Bitcoin and for general corporate purposes, which I assume is just
buying Bitcoin.
Yeah.
That is some levered Bitcoin, if I ever saw any. Decliners now, because Tim is having the good day, I'm having the down day. And so we're looking at Tesla first, which is having a very down day. It was the worst performer in the S&P 500 and the NASDAQ 100. And it was off the heels of news that shipments in China, shipments from its factory in Shanghai slumped to the lowest in more than a year. And so we're keeping an eye on that into tomorrow as well, but certainly one of the drags on the S&P for the day. I also want to keep an eye out on Apple as well, because we faced news this morning also of Apple being hit with an $1.8 billion or 8.1 billion euro fine, rather, $2 billion penalty from the European Union. And that was over an investigation.
How much is that in Bitcoin?
Oh my gosh, yes. I can't do the math in my head. I lost those skills in math class for sure, Romaine. But it is a lot of money. And there are a lot of questions about the consequences of a fine like this. Remember, this is into allegations that it shut out music streaming rivals. We saw Apple down today quite a bit. We saw it down more than 2.5% on the day. I also want to look at Spirit Airlines here, because we had finally the news. It was made official here that JetBlue and Spirit had terminated their deal that was highly scrutinized here by antitrust regulators in the United States. Spirit Airlines hired Perella Weinberg Partners as it seeks to think about the path forward here. It is focusing on returning to profitability and options to refinance debt maturities. Still, you saw Spirit Airlines down about 11% on the day. At what point it was down more than 15%, and at that point it was at the lowest levels ever. So keeping an eye there on Spirit.
Yeah, New York Community Bancorp also down 23% here on the day. And we go to the yield space. We talk about that 4-day rally that we had seen in yields last week here. That's now flipping to a sell-off, pushing yields just slightly higher here, 7 basis points here on the shorter end of the curve. And the longer end of the curve, as you can see there, only up by about 2 to 3 basis points, depending on where you look. That could change in a meaningful way with Jay Powell on Capitol Hill. A lot of Fed speak and a lot of economic data points, including a jobs report on Friday. Earnings season still in full swing here, and we're now getting Gitlab crossing the wire here. Their fourth quarter revenue numbers, they look good, but the share is moving lower. Revenue came in at $163 million. The street was looking for roughly about $158.5 million. Adjusted EPS also was a beat, 15 cents a share versus a street estimate of 8.4 cents a share. But it looks like the guidance here is what's giving people some pause. 2025 revenue, the company says, will range from $725 to $731 million. The top end of that range is below the average of street estimates. And you have a similar story here when it comes to the first quarter numbers as well.
Not to mention the fact that the stock is up some 18% so far this year. So perhaps expectations were getting loftier and loftier. And when it doesn't deliver on that outlook, see this bottom fall out.
And here's your adjusted EPS number for the year. A big miss there as well, Scarlett. 2025 adjusted EPS 19 cents to 23 cents a share as a guidance. The street was looking for 37.
That's a big miss.
Hey, the company's CEO saying in a statement that they're integrating AI throughout the software development life cycle.
Who isn't?
Yeah, that's. Yeah. I mean that. But when does it start to? I think when does it start to deliver the efficiencies that are promised? And I think that's one thing that investors are still waiting for at this point. It's like we understand the beneficiaries of AI right now to be, companies like, Supermicro Computer and Nvidia. But when do we start to see the gains being made in productivity from the companies that are actually buying these chips?
Yeah. Well, also, how much investment do investors start to stand for before they want to see that productivity, right? I mean, this is something that has been an area where has been really a competitive area for dollars and investment. Sometimes it's not how quick you can see that return, but how much return you'll get at the end.
Yeah, this is like the hottest sector out there. It's chips. I guess to a smaller extent, maybe some of the software names that are trying to sort of fold into that. And it was interesting, guys. There was an interesting story a little bit earlier on the terminal about the CEO of Snowflake who's stepping aside, who apparently, at least financially, is doing a lot better than Tim Cook and some of his peers.
So do you remember last week when we saw this news about Frank Slootman, and I mentioned the few things you know about him are his history at other companies, and then how much money he made when Snowflake IPO'd. At one point, guys, he was making over $100 million a month because of his compensation package.
Yeah, same.
Yeah. I need to have you negotiate for me, Romain.
Yeah, no, you don't want that, trust me.
According to the Bloomberg Billionaires Index, he has a fortune of about $3.7 billion. Not bad for someone who's not a household name.
And not a founder, right?
Yeah, an operator.
Yeah. Other non-founders have done well in the past, but I mean, this is like in such a short time. This is pretty incredible.
Yeah, well, Tim Cook, right? I mean, he's got to be like kind of one of the richest, right? At least in the modern era.
Yeah.
Yeah.
Guys, that's it. That's all the time we have.
Okay.
That is going to do it.
What'd you do with Carol?
She'll be back tomorrow, I think.
Oh, okay.
Yeah. Don't blame me.
I blame Shanali.
Hey, that is going to do it for our Beyond the Bell coverage on this Monday afternoon. It's our cross-platform coverage of the market close here on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Catch us tomorrow, same time, same place. Happy Monday, everyone.
All right, coming up here on the big program, a closer look at, grocery chains and Whole Foods specifically. Whole Foods apparently looking to lower its footprint here. The grocer opening new small format stores aimed at serving quick trip urban consumers. We're going to talk to Amazon Executive Vice President of Growth and Development, Christina Minardi, about that move. That's coming up next here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romain Bostic. For a while today, it looked like the S&P 500 was going to extend its record run and close higher at a new high for the 16th time this year. It did not happen. We pressed pause on the rally, with the S&P losing about 1/10%. We're seeing a decline in treasuries as well as yields move up on the 10-year to 4.21%. There's a lot of corporate bond sales coming up this week, $35 billion in supply before Jay Powell begins speaking before Congress on Wednesday. So there's a bit of a rush to get that in before that testimony begins. And of course, the jobs report comes up on Friday as well. It's not just the U.S., because in Japan, we're seeing the Nikkei 225 close at a record high above 40,000 for the first time ever. And Bitcoin is making a run for 69,000, which would be a record. We didn't get there yet, but inching towards that level. Let's move on to the individual movers here, because Hewlett-Packard, HPE, the ticker there, up by more than 10%, up for a third straight day, actually. Prior to its latest earnings, the stock had actually tumbled to the lowest since last June. So perhaps there's some short covering taking place here. We'll keep an eye on that one. Super Microcomputer, ticker's SMCI, being added to the S&P 500 along with Decker's Outdoor. That gave it a 19% boost. But we're looking on the downside at a very familiar name, and that is Apple, losing about 2.5%, well below that $180 level, on news that the EU is fining the company by almost $2 billion for violating antitrust rules by restricting app developers from telling users about alternative ways to stream music. Apple losing 2.5% on the day, and New York Community Bank remain a big decliner here, a familiar name as well. Over the last couple of weeks, we've continued to see pressure on this regional lender, losing 23% on the day today as Fitch and Moody's downgraded its credit rating, which of course will increase the bank's borrowing costs.
All right, a lot we've talked about here on the show. We've talked about the opportunities in AI, crypto, and everything in between. And, well, how about a discussion about municipal bonds? It's time now for our Muni Moment. And our next guest says that elevated supply and seasonality could actually make an attractive entry point for the sector. Stephanie Leroy-Cillier joining us right now, head of municipal business strategies at Invesco. Stephanie, everyone has their eyes right now on this market, a market that I guess to a certain extent has kind of trailed the Treasury market, but we've seen some life in this, and there's been a lot of optimism that here in March and really over the next couple of months, we could actually start to see a lot more of those opportunities open up. What say you?
Yeah, thanks, Romain. And certainly we are now getting prepared for the seasonality that typically happens in the muni market, where you have, once we get to tax season, we kind of mark that on March 1st, we're officially in tax season. We start to see folks sell munis. We start to see, less issuance in the market. And this time around, we have less money earmarked to come back into the market. Actually, we're going to see more issuance. I said less. So more issuance, less money earmarked to come back into the market in the form of maturities and coupons, and it should provide for a very nice entry point for those that have still been on the sidelines. We saw a lot of money leave the asset class in 2022, and we're still waiting for it to come back. So it could be a really great entry point for those that are looking at these higher tax bills. Maybe last year they got into a lot of different securities that paid great yields, but it's time to pay the piper, and munis could be a good way to avoid that.
Well, this is the issue right now, though, as you know, Stephanie. Folks are sort of not only just looking what they can make in the muni market, but looking at it relative to treasuries and even to corporate bonds. And when you look at that ratio, particularly with treasuries, at least on the surface, munis still look relatively expensive, are they?
So it depends on where on the curve. So we like the longer end of the curve. The longer end of the muni market is really where, folks still demand a yield. We still have somewhat of an upward sloping yield curve. So you're not going to see the level of inversion that you do, on the treasury curve. And so I'd say, for short term, yes, we're totally seeing that. It makes sense to sort of stay in the treasury market there. But, we like high yield munis. We like muni credit. We've been talking about it for a while. We like investment grade. I mean, muni credit altogether, whether you're investment grade or high yield, we do at this point in time like the longer part of the curve, and we think that's where you're going to get the most bang for your buck. We're talking about tax equivalent yields at the highest tax brackets of over 9%.
So I'm curious, Stephanie, how you're going to listen to the State of the Union and what that might tell you about the needs of different municipalities to raise funds going forward. I know it's a wish list from the White House, but still, there's always hints dropped in there, aren't there?
There are hints. I think what we've been paying attention to for the last couple of years now, since 2021, is just the surpluses that a lot of the states have had. We had $1.6 trillion enter a $4 trillion market in the form of federal stimulus post-COVID. That money's not going anywhere for a very long time. So most states are looking at, surpluses, rainy day funds that are at all-time highs. I mean, the governor of Illinois came out recently and said he expects to fully fund their pension. There's a lot of very positive news at the state level, and it's really all thanks to the federal stimulus we got a couple of years ago. So I think from a state perspective, we're in a good spot. I think munis are really in a good spot to weather even a recessionary storm. I know we're not talking about that so much these days, but it's still something that's in the back of our minds. And all the money we got from the federal stimulus is going to come in very handy should we face that.
How are you positioning for the November election? I know it's still a long ways off, and we know who the candidates are going to be when it comes to the presidential election, but are there certain areas that you're really focused on?
So, we've typically liked the transportation names. We've seen transportation in the United States come back very nicely. I'd say specific to the U.S. presidential election, what's interesting is we've looked at, over the years, how has the muni market performed during presidential election years? The last 10 presidential elections, so since 1984 through 2020, we had 9 out of those 10 years with positive total returns. The exception was 2008. We obviously had the global financial crisis there, so it was a bit of an outlier. But we do believe that this year is even going to be stronger because of a lot of the macro, noise that is still in the system. We think munis can benefit. Folks can take advantage of, the additional macro noise that I think the election is going to provide to the market. And so we think on a long-term basis, come the end of the year, folks that take positions in munis when they see this weakness will be very happy.
Stephanie, really appreciate your joining us. Stephanie LaRosiliere of Invesco, she covers the muni business over at the firm for our Muni Moment. Now, coming up on the close, activist investors are sweetening their offer to take Macy's private. We're going to bring you all the details next. This is The Close.
It's a huge week in politics. Tomorrow, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lyons, and Bloomberg's top political analysts will bring you live global coverage of both events, starting tomorrow. Bloomberg, context changes everything.
Let's talk about the drama surrounding Macy's, because Ark House and Brigade Capital are now raising their bid for the department store chain. They're now offering $24 a share to take the firm private. Macy says it is reviewing the offer, even as it recently unveiled a restructuring plan. So let's bring in now Joel Bynes. He is a former managing director at Alex Partners and current managing partner at Spruce Advisory. Joel, it's good to see you. I want to focus first on the announcements that Macy's has made. Tony Spring, the new CEO, relatively new CEO, has announced this strategy to close down underperforming stores and also really invest in Bloomingdale's and Bluemercury, those brands. How would you grade that strategy?
Well, first of all, thank you for having me on, Scarlett. And, I would say it's tough to give that strategy a grade because it does sound a lot like shrink to hope to grow later down the line. And we've seen a lot of retailers attempt that strategy. We've seen very few retailers execute that strategy successfully. So as a strategy, I would say it fits within the B, C range of strategies for retail businesses. As a strategy that's likely to lead to a growing, profitable Macy's in the future, I would say the jury is definitely out.
So the jury is definitely out. What do you make of this new and improved offer from Arkhouse and Brigade? How do you see this unfolding? Is Macy's going to take a bite at this?
Well, it's impossible to know what Macy's is going to do. But what I would say is the latest offer revision definitely reflects a sense of optimism about the value of the underlying real estate assets rather than an optimism about the future prospects for the business. Most of the dialogue between the two, at least the public dialogue, seems to be very much about continuing to operate as a retailer versus thinking about how we could be valued from a variety of other different perspectives, real estate being one of them, brand being another, and so forth. And so, again, not to hedge the answer, but it kind of depends on your perspective. If you are a believer in the ability of Macy's to turn itself around, and you are a believer in the future of brick and mortar retail, as I happen to be, then I think you come down on the side of let's give this operational turnaround a chance. If, on the other hand, you are not a believer, then that might lead you to a different conclusion.
Well, if you are a believer, then, Joel, I mean, what is the math on that? Because when you talk to folks who look at that real estate business and see value there, at least value from a financial standpoint for investors here, that leaves a business, the retail side of the business, that for whatever reason investors don't think there's any hope. Work through those numbers for me. What can Macy's say? What can they do to show investors that there is value in that retail side of the business?
Absolutely, Romaine. I think to be fair to both sides, I think at this stage, it is very reasonable for people to look at Macy's turnaround plan and be skeptical of it. At the same time, there are precious few examples of retailers that have real estate assets to the degree that Macy's has, selling them or leveraging them somehow for value, and then ultimately being successful. In fact, the retail landscape is littered with retailers that went through that in the 80s and the 90s unsuccessfully. And so to try to be balanced about both of these things, I think what's missing really is why are we going through this transformation strategy? To reduce the store footprint by 150 stores, by my math, that impacts north of 5 million customers that'll no longer be able to walk through the doors of those Macy's stores. What I would want to know is, why do we think we can't figure out how to make money with those 5 million customers in those stores? Why can't we figure out how to get those customers to become brand ambassadors and bring in other customers? What is it that's missing from the formula that would enable Macy's to become a better retailer in the future? And I think that's what's really missing from the dialogue.
Well, I'm curious why we haven't heard that articulated more. I mean, I can understand the overhead and them not wanting to deal with that, at least on some of those locations here. But if you fold that strategy into a broader e-commerce strategy, or as you said, a more targeted sort of brand ambassador strategy that we've seen at other retailers here, does that maybe not help to account for whatever loss of square footage?
Well, I think what it comes down to is the perspective that you want to bring to the mid-tier department store space. It's a very difficult space to compete in because they're being nipped away at the top and they're being nipped away at the bottom. At the same time, ever since the Federated merger in the early 90s, Macy's has been on a homogenization path. And the problem with the homogenization path ultimately is that you aren't providing anything unique or interesting to individual consumers in the locations that they want to be consumers. And for everyone that tells me that the mid-tier department store space is dead, I say then explain Dillard's, explain Von Maur, explain Boscov's. There is a possibility, there's a way to compete in the mid-tier department store space successfully, but it requires localization and understanding local communities.
Well, it's interesting, though, the names that you just put out there, Joel, are largely regional retailers, while Macy's at least is trying to be, or has been for years, a true national retailer. Is that the issue?
Well, I think that is the issue, Romaine, because that drove incredible operational leverage for Macy's in the 2000s and into the 2010s. But the problem is that the consumer landscape has shifted so much that the operational leverage is no longer sufficient to make Macy's a growing, profitable retail business. And what's lost is that connection with the individual customer. That it's not just about theater and magic. People want to say it's all about experience or theater. That's not what it's about. It's about individual customization so that you have a connection with consumers. So they have a reason to shop for you. And I think that requires much more localization than I'm hearing today.
And I'm no expert on this, Joel, but I go back to what you just said about homogenization. I remember when they swooped in, started buying up Marshall Fields in Chicago and some of those other individuals. Like, why not just keep that brand and the uniqueness of those brands? Keep the little old ladies in the basement making those chocolates. Why farm that out? I mean, they killed it. You laugh, but my mother stopped shopping there primarily because of that.
Chapter in my book about that's the beginning of the end of the mid-tier department store. So yes, I totally agree with you.
All right, Joel, we're going to have to leave it there. Really appreciate it. Joel Bynes over at Spruce Advisory, and tomorrow we will hear from Arco CEO and co-founder Gabrielle Kahane. This is Bloomberg. All right, time for a look back on this day. In 1989, the book and magazine company Time Inc. said it would buy movie and TV giant Warner Communications. It was billed as a merger of equals, but it was an audacious mashup, creating the largest media conglomerate in the world. And you know what? It was a failure. Too ambitious, if not ill-timed altogether, and built on a growth strategy that would financially hobble the company for years, decades. The strategy was that scale mattered most in the media business, and the quickest way to that scale was through acquisition. That included the purchase of Turner Broadcasting and Six Flags amusement parks back in the 1990s. But the biggest acquisition for Time Warner was not the one it made, but the one it received, America Online, in the year 2000, using an inflated .com stock valuation to orchestrate a shocking and lopsided deal that led to shareholder lawsuits, executive departures, and multiple regulatory probes. But the worst part was that the promised synergies never materialized. Barely a year after that deal closed in 2001, AOL Time Warner posted a record $54.2 billion first quarter loss. By the end of 2002, the company added to that, logging a $99 billion annual net loss. That was the biggest in U.S. corporate history then, and an inflation-adjusted dollars of about $143 billion remains a U.S. record now. The only companies even close are AIG's $128 billion inflation-adjusted loss in 2008 and JDS Uniphase, which logged a $104 billion loss in 2001. As for AOL Time Warner, well, it quickly unraveled. Chairman Steve Case resigned in 2003. AOL itself was jettisoned by 2009. Time Warner Cable was sold in 2016 to Charter, and Time Inc., it was spun off and later bought in 2017 by the magazine publisher Meredith. But history often repeats, and by 2018, AT&T, seeking to build its own media and entertainment conglomerate, took over what was remaining of Time Warner. That experiment didn't last either, and by 2022, the skeleton of Time Warner had been absorbed into what is now Warner Brothers Discovery. Now, it's way too early to say if this new iteration of one of the most storied corporate brands in history is a success, but since that deal closed in April 2022, Warner Brothers Discovery has reported more than $6 billion in combined quarterly losses, and not a single analyst on Wall Street expects them to be profitable this year.
It makes you wonder why David Zaslav and Warner Brothers Discovery haven't been targeted by activist investors as well, given that performance. Let's shift gears for a moment here, because there's a really interesting story on the Bloomberg terminal today about Whole Foods Markets and how it's turning to a smaller, more convenience store model here in New York City. The Amazon-owned grocer is opening shops that'll only take up a fraction of the space as its regular stores. This is part of a larger attempt by Amazon to lure in more customers while accommodating smaller spaces often found in urban areas. Here now in studio with more on this concept is Christina Minardi, Executive Vice President of Growth and Development for Whole Foods Market and Amazon. Christina, so nice to see you.
Thank you. Very excited to be here today.
So the concept is called daily shops. Can you give us a sense of the calculus behind price and value in focusing on this format in certain markets like New York?
Well, the great thing about being part of Amazon is the last few years we've made really good progress on lowering our prices. And the Whole Foods Market Daily Shop will have very good prices just like our Whole Foods Market stores.
So there's Whole Foods, then there's Whole Foods Market Daily Shop, which you're introducing. There's also 365. That seems like a lot of different brands under the one umbrella of Whole Foods. That can get a little bit confusing, perhaps, for shoppers.
Well, 365 was a brand store that we started in 2016, but then we converted those stores in 2019 to Whole Foods Market stores. And, it was a great experiment for us to test somewhat of a different concept. We have to constantly test and innovate. Daily Shop is a little bit different. Our 365 stores were about 25,000 square feet, where Daily Shop will be anywhere from 7,000 to 14,000 square feet. And it's really focused on a convenient shop for our customers. You'll be able to shop for either a quick dinner, pick up milk or bread, or you can shop for a charcuterie platter, a full dinner, everything that you need in a Daily Shop. But the idea is around convenience.
Our executive producer loves charcuterie platters, by the way. I am curious. I mean, when I hear 7,000, that sounds small to me. Maybe not for New York, but certainly in other parts of the country. Is this strategy primarily aimed at dense urban areas like New York City, or is this something we can see maybe deployed in other parts of the country where space isn't a constraint?
Well, for right now, we're concentrating on urban areas like New York City. We've been very successful in New York City. We have 17 stores. We opened our 17th store last January, and that's a regular size Whole Foods Market store. But for right now, we're going to concentrate on cities, and these are really like drop-in stores. So you can easily have your big store that you can shop at and do a very big shop, or if you need a quick shop, you'll have a Daily Shop.
So how are you going to make that determination about what to put on the shelves? Obviously, if you're going to a 7,000 square foot footprint, you have to be a lot more selective about what's there. So how do you make sure that you have not only what the customer wants, but that they're not going to be disappointed if they walk in there with the expectation that I should be getting everything I get at a 40,000 square foot Whole Foods, but I don't see that product here?
Yeah, well, the stores are anywhere from 7,000 to 14,000 square feet, and I was actually really surprised while we did the design. First, when you walk the store, you'll be everywhere you look, you're going to see food. Like there's never a blank space of wall. We've used every inch and really to enhance our merchandising. And I was really surprised about how many linear feet of each department we were actually getting in this smaller store. We've also done a lot of work the last couple of years in reducing our back of house just in our regular Whole Foods stores. So we've adapted that to this store. And if you think about it, these stores will not have full kitchens in the back and meat cutting rooms. So we'll be able to use that space for sales floor space. So we'll have a really good selection.
They're not going to have prepared foods there?
We'll have prepared foods, but it'll be grab and go prepared foods. It won't be the food bars like you typically see in a Whole Foods Market store.
I have to say, what you're describing sounds a lot like the convenience stores you might see in Japan or in Taiwan, where 7-Eleven presents something entirely different for the consumer than what we have here in the U.S. with slushies and cigarettes and beer.
Those are Slurpees, thank you.
Slurpees, yes, thank you. But to what extent are you looking at what's worked abroad for an idea of what could work in a dense city like Manhattan?
Yeah, we've definitely gone to Europe. We've looked at stores in Japan, and we've used a new firm that's actually based out of Italy to help us do the design on this store. So really trying to lean into what we're seeing some of our other countries are doing in this area. But again, it's going to have everything that you need. Produce department, fresh produce. It'll have specialty cheese, bread, fresh bread that'll be baked every morning. And really excited that we're going to be launching our juice and Java bar, where you can get fresh smoothies, a hot sandwich. It's the first one in New York City when we do Daily Shop.
I am curious if I could just get your thoughts here, just on the broader strategy for Whole Foods. When Amazon purchased Whole Foods, there was a lot of speculation as to what would Amazon really want with Whole Foods. And I think we started to see an articulation of that strategy. But going forward here, is the idea simply just to run this kind of, I guess, as a grocery company? It may sound as a dumb question, or is there going to be much more integration with kind of the Amazon ecosystem as we think of it, meaning that this isn't just about groceries?
Well, with Amazon, we want to create with Whole Foods Market world-class winners in the grocery business, and we want to continue to create Whole Foods stores. We have 75 in development right now, and also grow the Amazon grocery business. This is an area we're really going to win in.
Who do you consider your biggest competitor then in New York City when you launch?
Can't think of a good competitor.
not the bodega.
We all have, but we can really coexist, especially in a city like New York City.
Christina Minardi is Executive Vice President of Growth and Development for Whole Foods Market and Amazon. Thank you so much.
Thank you.
Really appreciate it. Slushies, Slurpees, kind of the same thing. Icy?
No. Oh my gosh. Icy? Seriously. First of all, Icies are better than Slurpees.
Wait,
it's Icy,
rankings.
then Slurpees, and then, I don't know, whatever slushy you're talking about. I don't even know what that is. But it gets, I love this discussion because it gets to that. I mean, we know, of course, in New York, space is so constrained. Yeah. And I am one of these people, I don't like going into large stores. I don't go into department stores. I like
You're a recluse. You don't like going shopping.
No, I like getting in and out, is my point here. So I can see the appeal of this for a lot of folks. But I do worry about those other folks, like my wife, who do just like to browse around and all day. And
yeah, she's like, wait, what happened to the thing that I come into Whole Foods for, right?
Exactly.
Yeah, well, it'll be the challenge to satisfy both of you, both customers. All right, let's take a look at how markets closed on the day. We did have a down day on the S&P 500 on equities overall, with the S&P failing to close at a record high, Treasuries also declining. All this before the big jobs report on Friday and before Jay Powell begins testifying on Wednesday and Thursday. You can see there were gains overseas. The Nikkei 225 closing above 40,000. That's been a favored international market along with India. And Romain, we've got to keep our eye on Bitcoin. We're getting ever closer to 69,000.
Oh, wow. I can't wait, Scarlett.
Not quite there, but, getting close.
When we get there, ices for everyone.
Slushies for everyone. Slurpees.
This is the close on Bloomberg.
It is Super Tuesday tomorrow. Republicans in more than a dozen states head to the polls, and so far, Donald Trump has swept the competition. And he may gain even more momentum after the Supreme Court ruled today that he can appear on the ballot. Joining us now for a look ahead is Bloomberg Balance of Power co-host Kaylee Lines. So, Kaylee, does this ruling today basically put the nail in the coffin on efforts around the country to ban Donald Trump from running for and holding office?
Yeah, it does, Scarlett. Not just in Colorado, where the Supreme Court made this ruling initially that he was barred from being on the ballot on the grounds of Section 3 of the 14th Amendment, which basically says that anyone who is engaged in insurrection cannot hold public office. This ruling from the High Court will not just apply to Colorado, but other states which have made similar decisions like Maine and Illinois. Essentially, what the Supreme Court found here is not whether or not Trump engaged in insurrection. They didn't actually touch that question. They just said actually enforcing Section 3 is a decision or a role that Congress has to play, not individual states. So obviously this is a win for Donald Trump. He said, in fact, this is a big win for America on Truth Social. He was talking about this at Mar-a-Lago earlier today, also pointing to another case pertaining to him that this court will have to deal with. Remember, in April, they will hear arguments in his immunity question, arguing, of course, that he should be immune from prosecution as a former president in the case here in Washington brought by Jack Smith regarding 2020 election subversion. It's unclear at this time as we await that actual decision from the Supreme Court when that trial could go forward, if it could happen before the election in November.
But just to be clear here, Kelly, when it comes back to the ballot issue, the state ballot issue here, does today's decision, does that effectively settle this matter? We're not going to see other states try to remove, whether it's Trump or even Biden, for that matter, off of any of these ballots?
Yeah, it's not likely we will, Romain, because essentially what the court said here is that this is a congressional decision, not one that states can make themselves. That is what the court found in this ruling, which is why it's applicable not just to Colorado, but across the board. This should be something that comes down to Congress, is the court's ruling. So, of course, that guarantees he will be on the ballot in Colorado tomorrow, which is one of just 15 total states that will be voting in this Republican primary. And it's very likely that Donald Trump could sweep all of those states, even though Nikki Haley did get a win here in Washington over the weekend. She won the D.C. primary, where only 2,000 people voted, but it does make some history. She's the first woman to ever win a Republican primary. It's just not clear whether she can win any of the contests tomorrow and whether she will still be in this race come Wednesday morning if she does not.
Kelly Lines, you can check her right at the top of the hour on Balance of Power, along with Joe Matthew, for all your political coverage. But we continue our political coverage here right on the close. Libby Cantrell joining us, head of U.S. public policy at PIMCO. And Libby, I guess now that maybe this whole ballot issue is settled, we can start to, I guess, look a little bit deeper here into sort of what might actually shape this race over the next few months, and more importantly, some of the policies that these two candidates are going to try to convince the American people are going to be best for them. Let's start off here with what could shape this race. And I want to talk about the economy and whether economic issues are as much of a determinant in presidential elections now as maybe they were over the last few decades.
Yeah, well, good to be with you. Yeah, so historically, it's the economy, stupid. The economy has mattered. It has weighed on has informed how voters vote. And we would still argue that, yes, of course, the economy still matters. There's an axiom in politics, gas and groceries, really sort of the price of gas, the price of groceries. These things still matter, and we would argue they matter even more given what we've seen in terms of inflation. We've seen a run up of food prices of 20+% since Joe Biden has gotten inaugurated. We know that is a big issue. But Romaine, in addition to the economy, and I think one thing just to point out is that, of course, on paper, the economy looks great, but because of those gas and groceries factors for voters, they don't really feel like it's great. Other things that do matter for them, the southern border, immigration. It's something that we hear from New York to California to the Midwest. Yeah. It's really top of mind for voters. And then other issues as well, foreign policy and what have you. So the economy is definitely not the singular issue, but it will continue to be front in mind for voters.
Certainly not a singular issue, but I think it's interesting how you phrase that on paper, everything looks great, but for a lot of us, when we're going about our day, we kind of still feel the effects of that inflation. And that really has raised a lot of questions here about the path for the Fed, whether not only whether they'll cut rates, but the idea of whether it's even appropriate for them to be doing any meaningful change in rates in an election cycle like this.
I would say, Romaine, this is probably the top question that we've been receiving from clients as it relates to this election year. How could the election, could politics inform the Fed in terms of their behavior? Would they be, in particular, more reluctant to cut as we get closer to the election? And actually, if you look back at the data, if you look back at every election cycle since 1980, the Fed has either moved rates, they've either cut rates or hiked rates in some cases, or they've adjusted their balance sheet in every election cycle since 1980. So the data would suggest that actually politics and the election cycle should not inform the Fed here. We do take them at their word here at PIMCO that they are going to be singularly focused, more on the inflation, not on their dual mandate, and making sure that they really do eradicate inflation. So we think that, again, they are not going to be influenced by the election cycle, that if the data suggests that they need to cut as we get closer to the election, that they will likely do that.
Yeah, although I'm sure both sides will be making a lot out of it anyway, regardless of what the data show, the historical data. One thing, of course, that we're going to look ahead to this week is the perhaps theater around Jay Powell testifying before Congress starting on Wednesday and Thursday. Obviously, Democrats want interest rate cuts to keep the economy going in an election year, while Republicans are pushing for him to scrap a plan to boost bank capital. How do you see him threading this needle, aside from just being really boring and not saying very much?
I think that will be, Scarlett, his job is really going to be, his focus will be to be very boring, to not generate headlines. Jay Powell is an expert at this. This is, of course, not his first rodeo, so to speak. So we think that he will be able to sort of thread the needle here. I do think there will be some pushback by some progressive Democrats on the Senate Banking Committee in particular about his rates policy and encouraging him to kind of get in front of, what potentially a slowing economy going into the election. I think he will have a very magnanimous answer like he always does. And then, as you said, Republicans on both the Senate and in the House will push back on what's called Basel III Endgame. It's this new, very sweeping proposal by the Fed in terms of capital requirements. I think we'll hear a lot from that. But again, boring is good in his case. And so I think he will try to be as boring, as magnanimous as possible.
All right, Libby, always great to talk to you. Libby Cantrell, never boring, head of PIMCO's head of public policy over at PIMCO. And be sure to stick with Bloomberg for our special coverage of Super Tuesday. Our coverage tomorrow will start at 9 p.m. Eastern Time and run to about 11 p.m. And also be sure to check out Balance of Power, which normally airs at 5 p.m. Eastern Time as well. Meanwhile, right here on The Close, if we do wrap up our coverage here on this Monday afternoon, we're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Some big earnings out of some big retailers this week, and that includes Nordstrom tomorrow. Mary Ross Gilbert joining us right now, senior equity research analyst over at Bloomberg Intelligence. And Mary, I was just looking at some of the analyst estimates here. There is growth here, but not quite the growth people are looking for.
Yeah, so I think with Nordstrom, when we look at the transaction data from Bloomberg's second measure, it's indicating that on the sales line, on the top line, that they might miss slightly on sales, but where we're really looking for strength is going to be from rack, and this is something that Nordstrom is very focused on. In fact, they were planning to open about 19 stores this year.
19 stores for Nordstrom Rack. There's always a question whether that'll cannibalize sales from Nordstrom proper. What is the value proposition of Nordstrom proper when Rack is growing so much faster?
Yeah, so I don't think there's a lot of cannibalization at Nordstrom, the full line store. They've always said that, look, the Rack is our greatest customer acquisition tool. And when we look at the transaction data and separate it between their off-price business being the Rack and the full line, we're seeing that the full line is probably down slightly in sales, but we don't see it down dramatically. It's just that we think that we'll probably see up sales coming from the Rack. And if I had to compare it, let's say looking at Nordstrom full line and compare it to Bloomingdale's, let's say, I think Bloomingdale's is executing better. Their comp sales were down just a little over 2% in the quarter, and we think that Nordstrom might be down more in their full line business. And doing some of our channel checks, we just think the stores at Bloomingdale's are just a lot brighter, cleaner. They invest in their flagships more frequently. When I took a look at the recent, at a local Nordstrom store, they need fresh paint. They need to change the hangers on designers, on the designer apparel. So.
All right. Well, that's interesting. It'll be interesting to see what they say tomorrow. Mary Ross Gilbert doing some shoe leather reporting there, going in and really taking a look at the paint jobs in those stores here. And, of course, this is all in the context of that big sort of turnaround plan put out there by Macy's. Meanwhile, some other big events to keep an eye on over the next 24 hours, including over in China.
Yeah, the National People's Congress will begin. And, of course, there's going to be a lot of eyes on whether there's any personnel appointments, but that's not likely. That's the indication we've gotten from Beijing. So Wang Yi will stay on as foreign minister.
And, of course, we're not going to hear apparently from the premier, which is typically a tradition there at the end of that year.
Things are changing.
Meanwhile, back here in the U.S., we do have the Super Tuesday elections. This is when we get the multitude of states here in the primaries that we should point out. Almost all of these primaries are foregone conclusion.
Yeah, I was just going to say the results are up in the air. We're waiting.
Yeah, this isn't much of a contest like in years past here. Trump pretty much has a lock on the nomination, as does the current president, Joe Biden, on the Democrat side. Meanwhile, that brings us back to what we do best here, and that's a closer look at corporate fundamentals. In addition to Nordstrom, we get some other important retailers as well.
Yeah, we're going to look at the off-price discounters as well. I mean, Target is kind of in that category, but certainly Ross Stores is. And we got an indication of what's to come from TJX last week. Also, CrowdStrike, another cybersecurity company, will be reporting earnings.
Yeah, okay, and tune in for that. Of course, we will have full market coverage for you, as we always do, right here on The Close and on Bloomberg Television all day long. All your politics coverage, that's coming up next after the break with Balance of Power. Thanks for joining us today. This is Bloomberg.